I believe we should be live, and we are live. We're live on LinkedIn, Facebook, as well as YouTube. And this is Real Fridays. And every Friday at 12:30, myself, Brock Cassidy, and Jeremy Potter, we circle as industry insiders within mortgage, housing, and real estate. We talk about what's the most pressing matters and the most pressing. You got to love it. How are you, man?
Yeah, Rick. I'm well. How are you?
However,
what's that?
Hold on. Let me try to fix something here. Hold on.
Okay. I'm holding. Just set me out here alone. I could do a monologue. Always wanted to do a late night talk show, early morning talk show, Morning Joe, something like that. Rick and I were talking about what topic would even make sense on January 3rd. And I think when he gets back, the thing we'll probably end up talking about is the changing kind of business models between the channels, or channel conflict between retail, wholesale, and some of the other structures you can have. I know late in the year 2024, we were hearing about part-time or full-time, real estate mortgage loan officer combos, either dual license or, hiring real estate agents in. So I know that's one of the bigger topics that Rick's been thinking about, particularly as a recruiter. I don't know exactly for IMBs out there how much of it's a real threat. I know from a production standpoint, any production in 2025 is going to be helpful, going to be important. So let's see here. Let's see if Rick's jumping back on. Or not. Maybe it's just going to be me talking about Jeremy's thoughts for the new year. I know one of the things that I'm looking at quite a bit will be real estate's influence on mortgage, or vice versa. I've mentioned a couple other contexts. I can't remember if I mentioned it last time I was on Real Fridays, but it just, hey man.
Oh shit, I can't hear now.
What's going on over there? Anything? I mean, this is compelling TV, don't get me wrong. But what's going on?
So we've been live this last 2 minutes.
No, I know. I've been talking. Yeah.
Oh, you have? Oh,
I mean, I was doing my best to try to keep it. Yeah, I was.
Yeah, sorry, I had a technical issue. What you bumped in and I got bumped out.
Is that what happened? Okay. Well, I was just talking about your text message and what I thought we might talk about today, just to keep it. I can monologue if I need to.
What's interesting is, especially as we talk to companies raising capital and companies that are aiming to enter in the space as disruptors, or as I don't want to say. I mean, there are. How would you categorize the startups? There are companies that are just improving upon existing processes, so that I wouldn't call that disruptors, obviously, right? They're just kind of improving upon what's already done, just doing it slightly better. And then there's real sort of shifts where you're eliminating steps, or you are either eliminating steps or just streamlining future steps of the mortgage process that really radically makes industry professionals think about the mortgage process differently, right? Like when the POS evolution came out, that was, I would say, deeply disruptive, because it was a question of how it made us think of the process slightly differently than thinking that the fulcrum of the transaction was the loan origination system, right? I would consider that a pretty radical, just sort of, not radical, but I would say pretty fundamental disruption of the mortgage process. But I'd say most companies tend to be just slight improvements on data security or ease of access, or you don't have to enter your password that many X number of times, or they're just in some cases substantive, but not really radical disruptions, but really substantive efficiencies that are introduced by way of just a better technology, right? Is there a third category before we go about it? So there's the disruptors, there's the status quo but better category? Is there a third category in your mind?
Yeah, I mean, I think one of the things that we would have to put as a third category is there's there's technology that doesn't make its way into the actual process the way you just described, that is sort of integration under the hood at best. I don't even know that I would say that it improves upon the status quo. It's just kind of like weaves together behind the scenes.
Yeah.
And that's kind of my third. So you could put that as a subcategory under status quo, I guess. Um, but it's really a question of B2B versus is it seen or felt by the consumer, frankly,
And
I
and and
think.
that and so that's the third category, is whether or not is
Yeah.
because if it's seen by the consumer or if it's B2B, um would that be a subcategory of the first two, of whether it's a disruption or just an efficiency of the process?
Yeah, because wouldn't you say, I don't know, like I was thinking of a B2B technology that was a true disruption, what would that be? That would be an interesting experiment. Like what would that be?
B2B would be like,
AUS?
like AMCs.
AUS?
Like, I mean, there are like cross value, class valuation. There's technologies to provide efficiencies between, a company that aims to deliver services to lenders and then aggregate those services from a myriad of independent appraisers, for instance.
Mhm.
And
Mhm.
how do you either disrupt that, because there's ideas that we've talked about around um you know rethinking what it means to have an appraisal on a home, and what you do with the data once collected, um versus just the simple traditional appraisals of the past, right? um but would that fit your box between the
Yeah,
B2B?
I think that makes sense. Yeah, yeah. That makes sense. I
you
like
know
that.
Well,
Mhm.
or it could be companies like Truve, or like the company we spoke to most recently, Attentive, around
That's the
im
status quo B2B,
that's
improving
the
on the
status
status
quo
quo B2
B2B,
boat.
just
Yeah,
providing a better, faster, more efficient solution. But
that's
but but I but in that space, though, don't you think categorizing how income is calculated, in what data set, what data points you're actually using to actually calculate someone's income, couldn't that be less of a status quo and more of like an innovative, like, how should we look at one's income differently than we've looked at it for the last 55 years or so in mortgage?
yeah, I think that's where I get in trouble. I think I get in trouble because I always think of that as impossible because you can't do it. You're just literally not allowed unless Fannie and Freddie are on board or give you the approval. So it automatically becomes status quo at that point. Unless you're doing it, like you said, in that PLS market you referred to, then maybe. But even that is so skittish, they don't go up really above and beyond Fannie and Freddie without calling it higher risk and hitting it with tons of points. So is that disruptive if you have to pay 9% to try something new? You know what I mean? Like that's where I get in trouble because I'm critical saying that that's not actually disruption because disruption's impossible because as soon as you try it, you either get priced out or you have to go begging to Fannie and Freddie. And that's just the way it is. I'm not saying that's going to change and I'm not even advocating for that to change. I'm just saying that's the reality, right?
Yeah. Yeah.
I don't know. Is that too cynical of you? I guess would be my question back to you.
No, I mean, I don't think it's cynical. I just think it's a realist view, because the point is we're doing what Calabria said that we're not supposed to do, right? And Calabria's perspective was the Fannie and Freddie are not intended to be sort of the innovators of new products, and that's supposed to be sort of the private market, and then Fannie and Freddie kind of does the rest. The problem is everybody sort of just is sucking from the teat of Fannie and Freddie, and so Fannie and Freddie become the big pigs in the mud, and all the piglets are just sort of all the lenders, and we've made so much money off of just delivering what Fannie and Freddie and the vanilla that they sanction that they will ensure, that it's stifled any and all real sort of product creation or innovation that I think from Collaborator's perspective was intended by design, right? Was to
Right.
encourage, and that's one of the questions I had more around if you privatize Fannie and Freddie, which I know everyone's afraid of the unknown, and those fears are very well founded, of course. But if you privatize Fannie, Freddie, and even Ginnie, it could be 100 Fannie, Freddies, and Ginnies, right? I mean, we could have a liquidity facility where there's 100 of these out there, with some assurances or backstops by the federal government, by the Treasury, whose main focus is to try to penetrate adoption and access to capital through what would be considered non-traditional means, qualifying means.
Mm-hmm.
You know,
Mm-hmm.
you know what I mean? Though, I mean, it's like, you know, I think part of the problem is the government's been the solution and the problem, right? The government to
Mm-hmm.
some degree
Yeah. Great
has
point.
been a
Yeah.
massive
Absolutely.
driver to a 67% home ownership rate, whatever it is, 66. Certainly not the best in the world, but you know, probably top 5, maybe top 10. But certainly at scale, probably the best in the world.
Mm-hmm.
But at the same time, because we've gotten so accustomed to the options that have been delivered, it just hasn't inspired. Like if you and I were making, you know, several $1 million doing what we're always doing, what's the incentive for us to be able to innovate, to do anything differently?
Right. Right.
So
I think
money
that's,
becomes the big obstacle to change.
yeah. Well,
At least one.
money and incentives, right? Like if your incentives are just hold on tight to survive, or hold on tight to what you've got, and incremental gains is truly the strategic plan, that's going to be the outcome. It's easy to
Yeah.
see that, you know, show me your incentives and I'll show you what your outcomes will be. So I think that's, to me, totally fine. I think the thing that always gets under my skin a little bit is that we don't like to be honest about that. And we like to use language and use even resources to talk about it as if it's something it's not. And
Yeah.
like that's the reality is, like, we are bound into this world. And I was talking to somebody recently, which was maybe mortgage is just this way. This is going to be the way until we get out of the sort of GSE process. Like if you have to use AUS the way we have to use it for over 85% of the market or 80% of the market, then this is it. There is no better way.
Yeah.
And I thought that was a really interesting. They were not asking it as a cynic per se. I think they were asking it as like an innovation question. Like if you were going to put a challenge question out to CEOs, product managers, Fannie and Freddie, everybody, I think that's a fair one to say. Why are we even bothering? Why are we even pretending? This is how it's going to be as long as the market is commanded by this percentage of AUS results, AUS feedback. I was like, yeah, that's actually a pretty good way to think about it.
You know, it is a great way of thinking that. The one thing that, and this kind of dovetails Michael's comment about another GSE, could that happen? The reason why I think it could happen is because, like we have this quasi private and quasi sort of, I don't want to say socialist because that brings in too many other sort of false nuances, but you know, we have these lenders that are inherently too big to fail, right? That the government will step in to, if Bank of America went under, even though as a private institution, publicly traded, but private institution, that's a non-government institution, the government will save Bank of America. The government will save Wells Fargo, right? The government will save JP Morgan Chase, right? When you have 80% of deposits in 4 or 5 national depositors, you effectively have a quasi-government organization that is public on the face, or private on the face, but really public, government guaranteed on the back end. And my thought is, if we pull these GSEs out of conservatorship and they're purely private investment arms, right? It seems to me that private capital would pool around various, almost like the way the credit unions evolved, where they evolve around specific constituencies, around, you know, Polish and Italians, a different immigrant or different different sort of philosophies, right? Credit unions will teachers and different things. It seems to me that capital will flow around specific pools of consumers, and the idea is to ensure that there's enough of these liquidity facilities for each of these pools of consumers, rather than there's just really three pools: Fannie, Freddie, and Ginnie. There's really, if you're a veteran, it's here. If you're conforming, it's there. But there's nothing for most consumers, which would be to say those who are self-employed, or those who have second jobs or third jobs, or in this evolving sort of new economic, in this evolving new economy of making money. It just seems like none of these systems were designed for work outside of the typical 40-hour work week with your W-2 pay stub. Everything else seems to be exception to that rule, and I almost feel like there should be other rules that should be the norm, that should be established.
I guess so. I think the relationship you are talking about is the relationship between documentation and the long tail credit model. In other words, if you had an innovation that you call a disruptor that would immediately give, let's call it, cash flow underwriting visibility to the people who need to make decisions about how to program that into the AUS, I think you would see Fannie and Freddie quickly pivot and adopt a technology they could trust around documentation of income, whether it's gross or not, gross or net. What I think would then happen is, can you achieve that in a credit model that has 30 years of data, 60 years of data, 100 years of data off of gross income? Like, how do you merge those two together? So even if you had the technology that existed to verify employment and real income immediately, wouldn't you be shoving that data into a credit model that is not built for that type of analysis?
Yeah.
And so as you price those loans, you would almost need a brand new credit model to price those loans, because it would be very difficult to look at a standard rate sheet and go, now we've got this new income. We'll just do like a metric system conversion to gross income and then price it that way. Like, it would get really janky. So I don't know that Michael's commenting that it might take another GSE. The implicit guarantee of the government, implicit or explicit, seems to be the backing there. So I don't know why, like, the technology innovation that would give you comfort around the credit risk profile for another GSE to jump in and be as competitively priced seems way more unreasonable in the next 4 years than a technology that appears does a pretty good job capturing cash flow and then converts it to
something that's
pricing.
digestible by the GSEs.
Yeah, that seems like maybe. I'd still not bet on it if it was on my FanDuel account. I'd still not bet on it, but that's way more likely, I think, than trying to get a big money player to say, I can put the depth of liquidity behind a brand new way of looking at income and employment in the next 4 years.
Yeah.
And I'm using 4 years just because it's a helpful political term, but it's also a helpful, sort of general metric for what's achievable in this industry. 3 to 5 years is generally a good like, this is how long it takes to do anything new.
You're flying
incrementally new.
Yeah. You're flying if you create that kind of change in 3 to 5 years, especially in that. It's, non-QM. We've been saying for 14, 15 years that non-QM was the new FHA. And it really hasn't moved the needle. Maybe incrementally, maybe what's about 4% or so all loans are non-QM, maybe a little bit more, a little bit less, but it's kind of hovered in that,
take an
single digit range.
Take an ecosystem like ICE. What's the incentive? You just spent all of this money putting together a system that's based on the existing documentation standards.
Yeah.
What would be your incentive to mess with that? Nothing. Why would you? I'm sure there's a large group of people in the capital markets who, if they heard this conversation, would basically say, if it ain't broke, don't fix it. You guys are always looking for something new and different, but It's just a
Yeah.
cyclical business. It's just a cyclical business. We're helping the people we can help, and that's it.
Quo, if you're built to make money on the status quo, if that's sort of the
Who's
drive,
not though? Who's not?
I don't disagree. I mean, we don't live in a vacuum, right? So yeah, I don't disagree. But at the same time, if your main objective is to make something fast, better, cheaper, less expensive for the consumer, that potentially could. It reminded me actually at one of these Housing Wire conferences. Stan Middleman was talking, and here's Stan. He's an incredible guy, legend in the business, runs an incredible company. He's become a very, very wealthy man, and he was like, he sort of pontificated, and he said, I don't understand what why all these loan officers cry about all these new products. All we need to do is do FHA, do FHA, VA, and conforming conventional products, and then just everyone else should just shut up and get to work, type thing. And the reality is he's a guy that runs an FHA streamlined shop, with hundreds of loan officers in a call center. And all he's doing is just ripping through his servicing portfolio, making millions of dollars doing it. I wouldn't really care about changing the model if it works and there's no jeopardy to it, the model. Why not?
Yeah.
So anything else that might disrupt that becomes something that could jeopardize the existing practices. So I don't know. It just seems to me that if money's the metric, which for to some degree for all of us it is to some degree or another, it just seems as though that if you turn that around home ownership and all the other things that we talk about as well, educating the consumer, getting people into homes, moving people from renting to home ownership, building wealth, all of these things, that's not what's going to make me the most money while I do this. It's how can I accomplish this and then make money while we accomplish the goal, And I think just philosophically,
I've learned a lot. Yeah, I think I've learned a lot in the past few years, working across businesses, across verticals within the industry, and across different clients within the industry. And I would say, like, the thing I respect the most about Stan's comments, as you paraphrase them, is that that's legit and completely reasonable position to be in. Like, what I think that isn't necessarily maybe as motivating to some in the industry to those larger goals that you mentioned around homeownership and wealth creation, per se, but it's exactly how the system is set up, and it's exactly what someone who sits on top of that system can do and should do, because it makes the most sense, it's efficient, and it works. Okay, well, those three things are typically a good sign in business. So I don't think any of the incentives are there to change the homeownership metrics in this country. They're just not. None of the incentives are there, and none of the systems or tools are there. It isn't more marketing. More marketing is not going to get more homeowners. And that's what the system is set up for originators to do. Market. They're sales and marketing organizations. Well, more sales and more marketing is not creating more homeowners. Okay, so let's just stop. I've learned my lesson. So education, financial literacy are definitely important, because when you have consumers entering the market, you want them to be equipped, resilient, understand everything that they're being told by the experts that they're forced to work with, agents and MLOs, and then move on. So I definitely don't. I see a tremendous value shining a bright light on financial literacy, responsibility, the tools and apps that exist to help people be more resilient when it comes as a renter or a homeowner. But definitely the system is not interested in creating more homeowners. There's plenty of homeowners. The system is full up with homeowners.
So do you think it, but that's the question of the GSE conversation is like,
the GSEs can't create more homeowners. They cannot. Not in their current form. And not maybe as private entities. Maybe as private entities they could. I like that. Because they could start to find inefficiencies in the market and address them. But I mean, you still have to have a place to buy. You still have to win a house under contract in the market. So I don't know. That I think that's a good way for CEOs, innovators, product management folks to approach 2025 is to say, what do we know? What do we know isn't going to change? And then what are we guessing about? And if you can answer those three questions, you can have a pretty successful year. But you're not going to create more business. You're just going to take business from somebody else.
What's interesting. So, and obviously in the tech and the startup organizations that you've talked to, so what's your advice to them, either them as leaders or the investors that are funding those companies? What is your, because the main sort of mechanisms of how business is done are pretty well situated. It seems like there's no shortcuts. It seems like there's just a long, if the impact is really either it serves speed, if it serves regulatory speed, in other words, there's a rush to implement a new solution or a new compliance requirement, like when like during the you had the GFE over to TRID transition. There was a kind of a regulatory mandate, and then there was a technology solution to kind of patch that, and then everyone kind of had to solve it, right? And there's been a couple of examples of tech companies who've been able to do that. What was that one company? The Smart GFE, that company that ended up getting acquired. They were built all around servicing that regulatory need that everyone needed a solution for. But what would you give advice to investors or startup founders trying to get traction, competing with all the legacy products?
Brand the bland. So it doesn't mean, just because I said sales and marketing can't create new homeowners, new customers, the reality is sales and marketing can absolutely win the market share battle and can absolutely win as James Moore, our friend, would say, the eyeballs and earballs battle, right? So there's still business to be done. You said last time we spoke that we're going to have, the market's going to have a T in it. It's $1 trillion market, even if it's 1.7, 2.2, 2.4. The bottom line is it's still a capital T $1 trillion market.
But 2.4 is times are good at 2.4. 1.6, everyone's sweating it out.
Yeah, and so everyone is going to sweat it out. But I'm saying if you had advice over how to do it, I think rethinking how you approach what you take for granted, what you don't see as a differentiator, and making it a differentiator. We're sometimes in our shops too close to the problem, and we don't realize what it sounds like to a consumer, what it could sound like to a real estate agent. I think that when I was living through the UWM rocket ultimatum time, what I think it really told me, and why I'm saying brand the bland, is you just have to find a thing that is not necessarily your differentiator all year, but you run a campaign around it and you differentiate and you try a bunch of stuff to see what works. And when it does work, you pour gasoline on it until it stops working, and you find the next one. I think that's the history of this industry as far as the market share battle goes. And I don't think that has to be depressing. I think that can be a pretty creative exercise. And I do think it takes all parts of your organization. I think sometimes the idea that it's totally up to sales and marketing to figure it out does limit the ability to brand the brand. You need the product folks, you need the technology folks talking to you about these little things, and then finding ways to call those flash sales, to call those a new feature, to call those some sort of new campaign. I think that's real. I think we should be seeing more of it. I don't think we're seeing a ton of it. And partly due to the defensive nature of protecting my referral sources, but ultimately I would say brand the brand.
Dude, I love that. And James is still running his broker shop, right? In Hartford.
Points Mortgage. Mm-hmm. All Points Mortgage. My
Good
friend
for
James.
him.
Yeah,
I need to
Rick
catch
and
up
I
with him
met.
to see how he's doing. It's interesting because I'm going to do an article here coming up pretty soon around the rise of the super broker, because there's a real rise of mortgage companies. There's about a dozen of them, perhaps even more, that I'm counting, 24 companies that are these, what I'm calling these super brokers, half of which are backed by UWM or Rocket, right?
Mm-hmm.
And what's interesting is they're all independent mortgage banks. They're basically just non-delegated correspondent, right? They're sending all their loans to Rocket or UWM, but they almost become their own retail face, their own invisible face of retail for UWM and Rocket, without them having to actually go into those markets. They just
I
invest in
mean,
those
I guess.
companies.
Yeah, I don't see it quite as clean as retail, like that it's just a invisible retail, but I see what you're saying, and that's fair. I think that's fair, especially in your position to
Well, when most of the loans
call
are
it out.
going to UWM and Rocket, how is it not fair?
Well, I think there's a couple reasons, but for the most part, I think the idea of who's responsible for the customer relationship in particular, but also for the referral source, means that Rocket and UWM can really mess with your business. Now they're saying they're not gonna. They're saying like we're faster, better, cleaner than you doing it yourself, than anybody else doing it. So you don't have much risk here. But the reality is, like, that's that person's name on it. Like, it is still their last name, it's still their brand on the key piece, which is the customer relationship, right? So when I talk to people who are friends and family who are going through the process with a broker, I always say, where'd they put your loan, right? It's, to your point, usually UWM or Rocket, and they don't know. They don't know anything about it. They're like United something, Rocket Mortgage, the TV commercials, right? They know the person that their real estate agent told them to work with. So that's all I meant, is that, like, in the community, this person's name is the name that they're telling their friends was a good or bad experience.
Yeah,
That's all.
yeah. It'll be, well. It's a function of just trying to build, capturing the attention in that customer relationship, right? Because the moment, like I was talking to one national player, top 10, one of these super broker players, and he was like, the moment we hire our own underwriters, you know, um,
Yeah, I'm not
Rocket,
saying it's not a fair
UWM,
trade.
we'll
Yeah.
just cut it off.
Yeah. There's a lot to dig into there, because I think, like, that is a real dilemma once you are the storefront and you do like the fulfillment, or even if you don't like the fulfillment, what options do you have? I think that's more your question, is like, can we just call it retail because they're as boxed in as anybody else? Um, and the switching cost, though, I think you as a recruiter would probably say the switching cost is pretty low. The switching cost is hard. It's not
Yeah.
easy, at least from my view on the back end. And so I think that is, it's definitely harder than a real estate agent. The switching cost for a real estate agent seems a lot lower than
Yeah.
LLOs, but it's, I think, a lot harder to go backwards from a broker shop than it is to go into a broker shop, to your point. But I
Yeah.
don't know as well. You would know better than me. Just my view from the outside looking in.
It's amazing. One of the things to keep in mind is, and this is where this is sort of the contraction in the business. So, and there's been a number of there's been a series of posts done on LinkedIn quoting the number of loan officers who renewed their license going into 2024, and which was over 200,000 or so, like all in, including, like, those are all including depositories. But if you look at it, so 195,000 loan officers did at least one loan in 2024, right? It could be just one loan. Okay. And, but in the last 3 months, only 144,000 did one loan in the last 3 months. So there's kind of a 50, and you can't live off of not doing loans. If you're a mortgage loan officer, unless you live on, you have your $4,000 a month base with the bank, and you're selling insurance and other products. And if the mortgage opportunity comes your way, then great. If not, no big deal. Like, but there's a 50, 60,000 reduction in the presence of loan officers in that space. So we're really looking at, and that's just one unit over the last 3 months,
Yeah. So 144,000 is, in what you're saying, is pretty much the top number of professional MLOs. If we use that criteria, is pretty good. I thought
195,000 going into the year, 144,000 to end the
by
year.
The fourth quarter. Yeah.
So it's interesting, but what I've discerned is that within there was about 70,000 loan officers that did one unit a month that were in the non-depository brokers or mortgage banks. One unit a month of the last 12 months, about 70,000. So we're really dealing with, we're dealing with probably anywhere from, it's as I tabulate this now. I mean, when you're looking at loan officers that do, who could really live on, this is in the non-depository space, brokers and mortgage banks. You're only dealing with about 3,000 loan officers. Like there was only there's not a lot, and that's in about. And that's in a subset of about 14 different states. And there's another like, I'm still piecing through these numbers, but it's interesting because we're only dealing with, if you look at in the United States, from what I can gather from the pieces of the puzzles that I haven't quite fully sort of assembled, I would say that we're only dealing with probably about 30,000 loan officers nationwide that really support most of the business, right?
Yeah.
And what's interesting about that is that has ripple effects across every tech vendor. It has ripple effects across every organization when it comes to trying to drive your production. And so there's all these interesting pieces of the puzzle of trying to figure out, if I'm a tech vendor, how do I price my product out? How am I building the efficiency out? Is it for the loan officers, or for the operations, or for the consumer? And then if I'm a mortgage lender, how do I leverage all these pieces for growth, or just to stay in the business, quite frankly?
Yeah.
No, it's fascinating. So I'm still sort of combing through that, and I'm hoping to publish more of a coherent sort of view of what we're looking at in 2025, because I don't really see, there's not a lot of optimism, at least, and I think Trump is being Trump, but there's just not a lot of optimism, or at least the optimism is being I think there's a cold shower in the optimism from the election to the present date, around what 2025 is going to look like versus what everyone hoped it would look like. And I think it very well could be another 2023 as far as the total numbers.
Yeah, it really depends on a lot of the day one, maybe first 100 days types of policies, and then what the ripple effects are, particularly on income. Like what I think, and then we'll know pretty straight away from there. But by then, you've already kind of baked your 25 budget and projections. So to your point, there's a lot of uncertainty, and that uncertainty is not getting any less certain, even while it gets a little bit more real.
Yeah.
Shower comment. I don't think it's getting any more dependable if you're an executive.
Yeah.
Hey man, I gotta go. I apologize. Yeah. I had to drop a few minutes ago. I good to talk to you as always on this Friday, this kind of snowy holiday week that was a little bit weird with the Wednesday to Wednesday.
Yeah, and Brock's on vacation, so he'll hopefully be back next Friday. And we'll have to coordinate exactly who we want as guests, in the weeks to come, because I know there's a number of people we could have. We've got to schedule it out.
Reach out to us if you're interested, and Rick, I'll send you some thoughts. Thanks,
all right, man.
Have a great weekend.
Take care.
Bye.